Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was looking through the comment section right here. It says, could you go over when you would sell a stock? Do you use technical analysis and ratios to tell you when to sell as well? And yeah, I do. I use technical analysis and I use the ratios. The ratios tell you relative value of an asset versus other things. Another thing I also use is the real estate cycle. Usually in a real estate cycle, some people call it the business cycle. It's really just the real estate cycle. It's a housing cycle. This is what the real estate cycle is. It moves in 4 phases in a continuous wave pattern. It goes from recovery phase to an expansion phase to a hyper supply phase and then a recession. This is the long-term occupancy average. And it just cycles about that average. Depending on where you're at in the real estate cycle, it determines kind of where your investments should be. In a recovery phase, it's really good for stocks down here. Stocks love low inflation with low interest rates. And the lowering of the interest rate and low inflation, which is usually has a it has a positive interest rate. What that means is that stocks do very well in that type of environment. When you go into an expansionary phase, the inflation rate kicks up. That inflation puts pressure on interest rates to go up. So usually this is an increasing interest rate environment under a high inflation environment with real negative rates. That's a mouthful. I get it. But an expansion phase is where commodities do very well. This is where real estate, commodities, and precious metals are the spot to be. Then when they build too many homes, they go into what's called a hyper supply phase. Your vacancy goes up, new construction is very high. That new construction builds too many homes, and then your inventories get replenished. Then the prices fall afterwards into a recession. So you have a very tight market going from a recovery phase to an expansion phase, and that's exactly where we're at. We're right at the beginning of an expansion phase. Where inventory is drawn down, we have a very tight market, we have high inflation, and we've got a real negative rate. Everything screams that we should be in commodities, precious metals, and real estate. Over time, and this is going to take some years, over years, we're going to go and we're going to build too many homes, potentially. Depends what the imbalance is. Our inventories will get built back up. We'll go to more of a 6-month to 10-month inventory level. And then you'll probably see a small pullback. It depends on how many homes they overbuild. If they overbuild a ton, then and the loans get too loose, we could have a pullback in housing. If we don't have a large production of new homes that are in excess, we could have just a very small sideways movement or a small decline in home prices for a period of time. And that all highly depends on how many homes are built and the supply-demand balance and inventory. In a recession, if we're going into a recession, bonds are the best spot to be loading up in a hyper-supply phase for the crash. Once you hit the bottom of the crash, you rotate into stocks, and then once you're in stocks, you'll have to rotate into precious metals and whatnot. And the best time to have done that would have been in 2020. 2019, 2020, 2021 was a good spot to rotate into commodities. And these are big long-term cycles. The cycle usually lasts about 8 to 10 years. So 8 to 10 years up, I should say, 8 to 10 years down. So it's 10 years up, 5, 6 years down. 10 years up, 5, 6 years down, something like that. And that's the cycle. This cycle is referred to as the business cycle if you want to learn it, but it's really driven by real estate. The real estate cycle is what drives the business cycle based off of credit, expansion, and contraction. At least that's what I've found. I use this as my buy and sell signals for certain assets. That's the rotation. And right now we are in the commodity, precious metals, real estate cycle. That's where I would put my money, the majority of my money in. And again, that's not financial advice. And then looking at it, and if we were to go back here, I can show you the housing starts. The housing starts is what drives this cycle. It's the loans against the housing starts. That is your credit expansion. Here's the housing starts. This is a long-term view of it. This is your long-term occupancy average. That's what that orange yellow line is, or I should say yellow. Whenever we go above it, this is an expansionary phase. This was the 1970s, big expansion phase. Came back, another big expansion phase. Commodities were overpriced in 1980. The 1980 and the top of interest rates, just on a big long-term perspective. Interest rates are all, there's a couple of cycles here. There's a big long-term cycle with interest rates, and then you've got these shorter-term cycles, which is the movements of the housing starts. And let me get into a really big long-term housing starts charts for you, if I can find it here. And I think I have it. 1 second. Should be right here. So here is the annual U.S. housing starts from a really long-term perspective. And there's a couple of things that you can glean from here. The red is the private starts, and that's what we'll be focusing on. Notice that you can see a massive bubble in the 1920s and then the break below the average in 1929. What happened in 1929? Oh, yeah, that's right. That was the Great Depression. It coincided with a contraction in credit. That is how these big deflationary busts happen. It's on the front end, you have all these loans going against new homes, which is a credit expansion. On the back end, it's the destruction of that credit. So if you have a big bubble, and they had a big bubble in the 1920s, the mid-1920s, they were giving out loans, they were just flinging stuff around, and then you could see it come back down. And when it crosses below the average, which is in here, that's when everything falls apart. Another thing that you want to look at, from the 1940s, we had this massive boom in housing starts, and it remained elevated all the way till a peak in about 1980-ish, when it came back down below. This cycle from here to here was the largest real estate boom that we've had in history. It was also a large inflationary environment from 1940s all the way to 1980, and a large increasing interest rate environment with that demographic coming in, buying a bunch more new homes. So we went into an entirely different level of housing starts. That was a very inflationary time frame. House prices went up dramatically from the 1940s to 1980. And under that same time frame, we're kind of looking at history, they were printing a bunch of money. That money was coming into the system. That's came from the housing starts. It came from this. We went to an entirely new level with the housing starts, and that was all inflation. That gold was a fixed price. So what happens when gold went to a freely traded price under a highly inflationary environment where people wanted to get out of stocks and bonds? They ran to precious metals and repriced precious metals in the 1970s all the way to 1980 under an increasing interest rate environment with high inflation. Those are the market conditions that thrive, that precious metals thrive under. High inflation, increasing interest rate environment. What are we coming into right now? We've got a large decline. I'm tying this all together, guys. This is what makes you a lot of money. You've got the 10-year yield here. All right, this is a long-term perspective. This, when I was talking about the 40s and whatnot, this was your increasing interest rate environment, right? This is a huge increasing interest rate environment on the left here. Big increasing interest rate environment. This is where precious metals go ballistic, real estate goes ballistic, commodities do very well, like oil and all of them. We've got this declining interest rate environment where we're breaking it to the upside. What potentially could be coming is an increasing interest rate environment versus a declining interest rate environment. The 1980 till today, the 40-plus year environment that we have been in could be changing on like a game-changing paradigm shift. Maybe. Again, guys, I don't have all the answers, but what I'm telling you is we could be breaking this long-term downtrend in interest rates, going into something that's completely different than what most people have experienced for the past 40-plus years. And you know, I'll put it this way. Stocks could go into a very prolonged period where it's going to be very difficult for them, because in an increasing interest rate environment from a very low interest rate environment, stocks are going to get repriced differently. So are bonds. You could see bonds go down by 90% plus in a very large increasing interest rate environment. Now, everyone tells me interest rates can't go up. They can't go up. They're going to have to hold these things down because they can't have the interest payments on the debt to get too large because it'll bankrupt the the country. Maybe that's the case. I don't know. Maybe that's the case. Maybe it's not. But I can tell you this, the pressures will be there. The pressure for interest rates to go up with people selling bonds are going to be there. So they're going to have to create a lot of money and buy a lot of bonds to hold interest rates down. Interest rates are just a reflection of the supply demand and what people are willing to pay in bonds. That's all interest rates are. It's just a reflection of the supply and demand of bonds. So interest rates, when you have a lot of sellers of bonds, are going to clear at a higher interest rate because you're going to have to find that equilibrium. If there's a lot of bonds out there and you have a lot of sellers, that means interest rates will go up to equalize the supply demand of bonds, the buyers and sellers. What I'm telling you is under a very highly inflationary environment, there's going to be a lot more sellers than buyers of bonds. And that's why they have to do QE to hold rates down. They have to buy all these extra bonds that nobody wants. What I am telling you is we could be going into an environment where there's going to be a lot of bond sellers. And if we are going into that type of environment, commodities might do well for a very prolonged period of time. We could be in a commodity bull market. It could be 30 years or 20 years. So I don't know. I think we're at the start of it. I think we have a lot of very good potential ahead of us. Every metric that I measure, whether it's commodity ratios, whether it's commodities priced in dollars, whether it's interest rates, they're all showing me, everything is showing me that we should have a big commodity bull market, big precious metals bull market, and that's where the investment should be. I was really early. I've been doing this and buying this from 2018, 2019, 2020 in different sectors. I've been buying physical precious metals. I think we're going to see a shortage of physical precious metals at some point. I don't know when. But at some point in the future, there's going to be a whole bunch of demand for it. And if they continue to try to hold things with the paper market, you could see shortages of the physical items. And it could be shortages of investor items, maybe not the industrial, because if industry needs it, they probably are just going to contract directly with the mines, and then they're just going to start grabbing it all before investors can. So we could see shortages of investment type things, and then eventually shortages of industrial metals as well. So I think we're at the bottom of commodities. We're starting to come on up, and we've already started that move. People are obviously noticing it. And then what happens is it's going to feed on itself. Inflation will feed on itself. Investors will keep piling in because of FOMO, fear of missing out. And retail will get sucked in at some point, and then we're going to see a big move. And it will accelerate. We already have big moves. It's starting. But I think this is the beginning of the start, not the end of the start. So, and what I mean by selling's way off in the future, in my opinion. I'm not selling anything. If I were to sell something, the stock is not providing leverage to the move. If it's not providing what I want it to do, then I'm willing to sell it and buy something else. So certain companies may or may not. Some companies lag, and lagging's not necessarily bad. So I wouldn't be too quick to pull the trigger because we're at the beginning of this. And I'm actually looking for laggards right now to buy that are lagging behind everything. They may not lag in performance. They're just lagging in their time frame to outperform. So I'm looking at these things that are still down. I'm trying to find whatever I can. One company that looks kind of good is Pedevco, PED. Energy service companies look really good. But I'm finding them. I'm investing in them, whatever I can. That's all I can do. And then I'm holding on. The selling won't come until interest rates are high, when the housing market gets into a scenario where we have a lot of inventory, which we don't have right now. And then the ratios get expensive. But the ratios, for the most part, are still very cheap. Oil's getting a little more expensive. Uranium is it's way cheap. And there's no reason for me to sell at this time. So I still think that we're years away from a top. It could be many years. So what do I do? I just hold on, and I continue to accumulate what I think are the best opportunities. Energy service companies right now are very good, and so is uranium, in my opinion. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.